Good morning and welcome to today's 5 with Fitz. I've just come back from a lovely run, and boy, here in the Pacific Northwest, the air is just so crisp at the moment. It's fantastic. I wish you could experience this. But meanwhile, let's get right to the markets. They're giving skosh back as I record this, which is absolutely consistent with the short-term trading mindset that is constantly at odds with long-term investing. Now, that's not a problem like most folks think. It's a pattern. And critically, an opportunity. Remember that volatility isn't the enemy, at least it's not our enemy. It's the price of admission for serious investors. Take a look at the image that I've got in the written version of the 5 with Fitz, and you'll see what I mean. It doesn't get any clearer than that. So keep your brain sorted, stay focused, because that's how you do things. So here's my playbook today. Number 1. The S&P 500 is up nearly 20% in 25 days. Now, what does history suggest about what happens next? Investors, frankly, can't help themselves. Every time the markets run sharply higher, like they have recently, and I've been doing this a long time, I start hearing the chorus. When should I sell? When should I sell? Well, what I'm about to say may surprise you, to a point I have made many times over. Big upside moves often create still more big upside moves, particularly if they're happening at critical points in market history when there are major challenges or changes, including fiscal policy, liquidity, and regulation. Now, we have all three of those things right now, so it stands to reason this is going to be a pretty big deal. Now, my research shows that anytime the S&P 500 pops by more than 15%, the median gain 12 months later is 20%, give or take. Now, will there be selling in the meantime? That's a different question, but the answer is absolutely yes. The markets require buying and selling to work normally and to build the base needed for another leg higher. So that's why I encourage investors to focus on what they can control, like buying great companies, position sizing margins, etc., all the stuff we talk about normally, rather than worrying about what they can't, like policy or the Fed or what China does next, etc. I mean, focus on what you can control, forget about what you can't. So the investing tip here in this area is something that I learned the hard way. The markets move fast, but great investors move first. So be one of them. Let's talk about number 2. Dick's is buying Foot Locker. Now, that's all over the headlines today, but it's makes me wonder. The story is being billed as an attempt by the former to lock up Nike's market by taking the latter out of the game. And the thinking is that the combined company will have a competitive edge in Nike's sneaker market with younger buyers, while also providing Dick's international exposure, access, and a younger, more urban consumer market that they've not been able to crack. Now, like many things, I see another angle here. I've been in this game a long time. Moves like this aren't always growth plays they're sold as. They're often survival tactics. Think about it for a second. Dick's is down about 10.4% over the past 12 months, but Foot Locker, which began an aggressive turnaround on April 16th and has tacked on 115.8% since then. Now, rising costs, inventory drag, and shrinking foot traffic mean both companies are under pressure. Now, that's why I say this deal smells less like expansion and more like consolidation to stop the bleeding. Now, it's a defensive crouch, not an offensive strike, to put it another way. Now, while we're on this subject of this, Nike, for its part, is still under tremendous pressure. Margins are thinning, competition is rising, and the brand's once nearly bulletproof appeal with younger consumers isn't as certain as it used to be. The stock is down 32.16% over the past 12 months. So the prize that Dick's is banking on here may not be able to deliver the competitive edge they're hoping for, at least not without a serious turnaround. So what to do? Well, I think there's a great trading idea here. You short or avoid all three. Put skis, a bet that stock will decrease, especially on Foot Locker, which has popped, and I had to read this twice today. It has popped nearly 83% today when I looked. I mean, that's amazing. You don't look a gift horse in the mouth, but you can take action. I think short-term traders have just taken those guys for a ride. So think about it. There's an opportunity. Number 3 today, Powell's masterclass in hindsight. Fed Chair Jerome Powell says, quote, "We may be entering a period of more frequent and potentially more persistent supply shocks." Yeah, thanks, buddy. It took you, 4 years and a shredded middle class to figure that one out? I mean, this really chaffs my jets. And forgive me, folks, for getting up on my soapbox for a moment. But Powell constantly acts like what he says, this in particular, is some sort of brand new revelation. It is not. Anybody who's buying groceries, paying for medication, child's education, daycare, running a small business, filling up the truck, knew this ages ago. Now, meanwhile, he's still trying to balance policy like it's 1895. I mean, from an investing standpoint, fortunately, there is a solution. Anybody betting on Powell is making a big mistake, and one that ought to be self-evident at this point. So I say, don't bet on Powell to lead. Bet on the markets to adapt faster than he can pivot. My 2 cents is that you ought to be thinking about companies with plenty of pricing power, low betas, and the capacity to protect margins. That's the stuff you want in your portfolio right now. Now, hopefully, you've got a few of them in your portfolio, speaking of which, but if not, and you'd like some help, you know what? You might enjoy one bar ahead. Number 4, Boeing gets a bailout in disguise. Qatar just became Boeing's white knight when Boeing landed a record-breaking order from Qatar Airways, up to 210 wide-body jets plus 400 engines from GE Aerospace. Now, the deal was inked with a lot of fanfare. U.S. President Donald Trump, the Emir of Qatar, Sheikh Tamim bin Hamad Al Thani, big smiles all around, and it's being spun as a historic win for the U.S. manufacturing and diplomacy. Now, I don't do politics, I do money. So I say, scratch, get beyond the surface. This isn't about the airplanes. It's about optics, politics, and buying goodwill. And the timing isn't accidental. Boeing has been limping through one of the worst stretches in corporate history with repeated safety failures, a brutal cash burn, production nightmares, and a bruised reputation just to get started. This deal props up confidence on paper, but whether or not those planes actually take to the air or the orders stick is another story. Meanwhile, investors are cheering, and honestly, yours truly, I'm kicking myself. Why? Well, it's time to eat a slice of humble pie. I mentioned a while back that I thought Boeing would be really interesting at $150 a share, but I didn't believe my own eyes when it tagged a low of $128.88 per share in early April. And in fact, I forgot to set the price alert that would have otherwise reminded me that that was the case. Anyway, translation. So I've missed a 60.92% run up since then. Now, is it too late to buy Boeing? Likely not, but the question to think about is how much upside there really is, and that comes down to how many more Qatar-like orders are out there and have yet to be inked. Now, I think Leap's calls could be a better option, pun absolutely intended, but that's just me. On a related note, this is interesting because remember, nothing happens in isolation in the markets. I've got to believe that China is absolutely seething because of this order, because it effectively locks out the C919 that it was hoping to feed into Middle Eastern fleets here within the next few years as that nation's charm offensive continues. So, key investing tip is a look in the mirror, something I always tell you to do. Mistakes are tuition, even for me. Number 5 today, HBO Max is back again. Warner Brothers Discovery is renaming its streaming service to HBO Max this summer, walking back the whole Max branding that it introduced just 2 years ago. Remember that? Anyway, you can't make this stuff up. The goal would focus on quality over quantity, according to management, and remind viewers that HBO still stands for prestige storytelling, not just another bucket of reality shows and reruns. Now, personally, I can't recall the last time I watched HBO, but that's just me. Of course, I'm a card-carrying member of the Graybeard Club. I also remember when hotels trumpeted the fact that they offered free HBO as a marketing ploy and a gimmick to get you to stay there. Streaming today is a brutal business. Subscriber growth is slowing, content is expensive, and even the big dogs are rethinking their game plans. The industry is rapidly shifting to bundling, ad-supported tiers, and profitability over growth at all costs. All of which, incidentally, made investors leave cable in droves when that industry did very much the same thing. I think it's only a matter of time before it happens to this one too. Meanwhile, there are bigger fish to fry like, Netflix, for example. Maybe you heard of those guys. Time to think. Today's bottom line, many investors get bound up in the minutia, and that's a mistake that almost always works against them, like it did for me. When in doubt, you gotta zoom out. Your portfolio really will thank you. Meanwhile, I'm with you every step of the way. As always, let's make it a great day. You got this, I promise, and I will see you tomorrow. Bye.